Hello everyone, hi, welcome to the channel of Wall Street Mojo.
Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon.
Friends, today we are going to learn an important topic that's called solvency, one of the most important thing that every company is looking for. So let's understand. See, solvency is the ability of the firm to continue, this is a very important word, to continue its operations for a longer period of time. So the whole concept is to continue the operations for the perpetual period of time, you can say. So what exactly is the solvency? Well, solvency is basically the ability of the firm to continue its operation for a longer period of time. So in simple terms, solvency basically ensures whether a firm is is it stout enough to pay off its long-term debts. So the basic difference between the liquidity and the solvency is all about the firm's ability to pay off its short-term debt. So in the case of liquidity, or long-term debt in case of the solvency. So here, instead of taking the company's example, we'll try to understand the solvency from an individual perspective. So taking individual perspective will ease. Remember one thing, what we are doing is we are trying to learn the individual perspective over here. The individual perspective is going to ease off the process, as an investor who is investing into companies individually would be able to understand when to go for big investment and when to retreat. So let's take a solvency example. Let's say there is a guy called Mr. Gordon who wants to invest in a company. His friend basically told him that it's a very good idea to invest into a particular company since the company is doing quite well. But Mr. Gordon, he isn't sure whether he has enough money to into something, so he goes to one of his friends who invests into the company. The friend tells him to look at the solvency of the individual account. So what exactly comes up? I'm going to bifurcate over here as assets, which is the first thing, which includes your cash, house, car, and any other assets. So your cash, let's say if this is 50,000, 2 lakh, 15,000, and let's say 10,000. So these are the assets. This is what he's going to look forward to. Then there is liability. Any, let's say, educational loan for his, let's say, for his first child that he must have taken, let's say 30,000. Then mortgage on the house, if any he has taken, let's say 1 lakh. Credit card debt, if any, which is, let's say, 20,000. So Mr. Gordon now, he decides to find out how much the total assets he owns and how much total liability he has to pay off. So the total asset over here, cash, house, car, other assets, which will give us our total assets. So our total asset is going to be alt is equal to, which is 2,75,000. And then we have the liability. So our total liability is going to be 1,50,000. Right? This is our total. So now Mr. Gordon wants to know his net worth. So his investor friend mentions after that after liquidating his assets and liability, if Mr. Gordon sees that he is still left with a positive net worth, he should go ahead and invest in that particular company. And his another friend suggested. So if Mr. Gordon finds that his net worth, that is your net worth, if his net worth is negative, then it's better to first to pay off all its additional debt. So Mr. Gordon deducts his total liability from the total asset and comes up with the following. So the net worth goes something like this, is equal to your bracket, the total assets less the total liability. So your total assets is equal to 2,75,000, your total liability 1,50,000, which gives you your 1,25,000 as the net worth. So from the above calculation, Mr. Gordon gets clear idea about what he should invest in a company right now or not, since his net worth is positive and he would have a healthy amount in his pocket even after paying off all he owes. he decides to go ahead with his investment. Now, let's understand the solvency of a company. Now, if you're running a business, you want to invest into a project or buy a chunk of shares if you want to in a new startup. So first you need to find out how much the net worth of your company has. If your company is liquidated immediately, can your company be able to survive for some time at least? I would say some time at least. So for example, the approach would be a bit different, because in the case of the companies, you need to think through of fixed expenses. Okay, the fixed expenses, your variable expenses every month, and your production cost, serving costs, and so on and so forth. So as a company owner, you need to make sure that you have at least 6 months to 1 year of working capital ready before investing in any new project. So plus based on this, you will require additionally, the company can use its D to E, that is the debt to equity ratio, the DE ratio, and any interest coverage ratio to find out whether the firm is able to pay its long-term debt or not. Now, the debt to equity ratio would tell the company that whether its equity, if its equity is enough to pay off its debt, right? Or else the firm can check its income statement and can find out the EBIT and the interest charge for the debt payment. And they will get an idea about whether they have enough earnings before interest and taxes to pay off the interest payment for a debt. However, whether to invest in a project or not is completely a different ball game altogether.
So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.